All right, and welcome, guys. I'll let you guys filter into the room, and we'll see how many of you there are, and we'll ask a few questions here in a second. So welcome on in. If you're looking for an event on cost segregation, energy credits, 179D, all sorts of 45L, all sorts of cool stuff that you get benefit for if you're rehabbing, if you are building, if you are a investor in real estate, you're in the right place because that's what we're going to be going over today. Before we get started, as I see you guys filtering in, first off, my name's Toby Mathis. I'm one of the founding partners of Anderson Business Advisors, and I'm joined by Erik Oliver, who is a vice president over at Cost Seg Authority. So first off, welcome, Erik.
Thank you. Thank you for having me, Toby. I'm glad to be here.
Yeah, and we've done a bunch of these before, but never really have we seen this much activity in this space. There's new laws that have been passed that benefit you if you are engaged in any of the activities that is mentioned, either as an investor, builder, substantial improver, rehabber, developer. If let's say you're buying an old hotel and you're making it into rental units, whatever, there's all sorts of incentives out there for you. And it is very complicated right now because we have laws that have passed the House, haven't passed the Senate yet, right? So we have changes that are still occurring on a continuous basis, and it's just important to get your head around which one of these incentives could apply to you, what the benefits could be, and so we can make sure that we take advantage of them. You guys can absolutely put questions in the Q&A. If you have a long question that has to do with you, put it in the Q&A. If you have a comment, put it into chat. Like there's already a bunch of comments like, will this be recorded and a replay sent it to you? Yes. We are going to record this. I'll probably place it on my YouTube channel. If you've not been to my YouTube channel, just Google Toby Mathis and YouTube and just go ahead and subscribe to that channel because I put these types of videos out and make sure everybody gets a copy of it. So please do that. Just because you're registered today, you'll also receive a copy of this as well. Now, there's two sides to this. There's going to be the presentation, and then there's going to be some Q&A. So somebody just asked, like, for example, I'm in the Q&A. I have to answer this. Is this for folks who have no investment properties? Erik, what do you think on that one? Like, it's probably going to be a no. Like, you got to have real estate, or you got to be developing or building real estate. If you're building real estate and selling it, then it applies to you. Certain things you'd actually have to have. You'd have to have the actual property.
Yeah, definitely.
Yeah. So we'll go through these. Don't worry. But for your questions like that, put it in Q&A. For all other comments, like see, we can put that into Q&A. There's a big old. I just saw a big question. Throw that over in the Q&A so we can make sure we answer it at the end. A lot of your questions will probably be answered during the presentation. If I see a bunch of questions that are similar, I might interrupt Erik and bother him and say, hey, here's a question that a bunch of people have asked and just get clarity. Otherwise, I'll wait till the end. Real quick, just because we want to have some fun, where are you guys sitting today? Like what city and state? And that way we get to know just how far a reach. So Northborough, Massachusetts, Greenwich, Connecticut, Mapleton, Utah, Blue Ridge, Georgia, Savannah, Georgia. Love Savannah. Melbourne. Oh my God, now they're going too fast. There's oh poo. They're flying. There's a bunch of you guys on. Wow. You guys are good showing today. Annapolis, Seattle, San Francisco, Sacramento, Miami, Florida, home of the 3% property tax. I think it's like that. It's like you guys are just getting gas, but I love that. That's where I met my wife. Florida, Atlanta, Florida, Portland, Oregon, Melbourne, Florida, Sioux City, South Dakota, Napa, California, Oceanside, California, living by the beach. A little bit of salt in that one, Riverside, because I'm in Las Vegas. I'm in the desert. Just had the Super Bowl. We're trying to recover. Kansas City, Redlands, Virginia, New York City, Alberta, Canada, nice. Mexico City, Huntington Beach, Broomfield, Las Vegas, Vermont, Philadelphia. I actually grew up just outside of Philly. Let's see, Loudoun, San Francisco. I don't see a Hawaii yet. I'm always looking for Hawaii. Branson, Orlando, there's Los Angeles, Thousand Oaks, Troy, Michigan, West Palm Beach, Omaha, Falls Church. We got people from all over the place. I got Calgary. Oh, there we go. There we go. Molokai. So we got Hawaii in the house. All right. So we're getting all the coast. There's another. Yeah. So Honolulu even. Okay. Now they're all showing up. Okay. So we have people all over the place. Erik, here's a question. Does this apply all over the place?
Yes, it does. Anybody who has revenue generating property is eligible for cost segregation, no matter what state you're in. So actually, even doesn't matter what country you're in, as long as you're paying US tax on it, you may be eligible as well. So if you've got
That is a great point. So it's if you file a US tax return. We have San Juan, Puerto Rico. Beautiful city, Elmer. Beautiful. But you guys don't really pay that much in tax. You guys got your crazy like 0% capital gains rate. Everybody wants to go live in Puerto Rico. I have clients that go move there just because they don't have to pay the tax. Anyway, so we can all hate on Elmer for a little bit. But yeah, anywhere. So like if I have properties in France and I want to do a cost seg on them, I can do it.
yes, as long as you're paying US tax on it. Absolutely.
Yep. All right. So guys, I'm going to hand this to Erik and let him do his thing. I may interrupt if I get lots of questions. Otherwise, I'm going to be in the Q&A feature. And if I'm not answering your question, chances are I'm tabling it so that Erik and I can answer it towards the end. And so, Erik, I'm going to get out of your hair. Sorry about that.
Come on.
And give Erik a big old a thumbs up, a heart or something, and let him know that you guys appreciate him being here. He's going to come in and blow your socks off because this is what his firm does. This is all they do. They are a specialist in this area. We send all of our people. I'm going to send you the link right now. So everybody has it. We send all of our people to Cost Seg Authority. And because you're an Anderson, because you're with Anderson, you use the link I just sent to everybody in chat, and they will not charge you to do the analysis. You'll know whether it makes sense to you, and you won't have to pay a dime. That is a huge benefit, just to have somebody do a quick analysis of your property and tell you, based off of your situation, whether or not it's going to move that needle from a tax standpoint. So it's really important. So I put that in there, andersonadvisors.com/CSA. You could use it anytime you want. It's not a time sensitive anything. It's just, we have a great relationship with Cost Seg Authority. They've done over 20,000 studies. I think last time I talked to one of your VPs, or was it your CEO? I think he had just right around 20 audits total out of 20,000 reports. I want you guys to understand that this is not a risky strategy. If you do it right, you don't get audited. And the fact of the matter is, when you use an engineering study like Cost Seg Authority on any of the strategies we're teaching, you are going to be fine like wine, never an issue. So we will make sure that we get that shared out link to you guys, and I'm going to hand it to Erik. So thanks for being here, my friend, and I will see you when I start asking questions. I may interrupt you, but I'll try not to.
No, feel free to, Toby. Thanks for having me. Glad to be here, guys. Thanks for joining today. As Toby mentioned, we're going to kind of talk about three different, I don't want to call them tax strategies, three different parts of the code that are two of them extremely underutilized. So we'll talk a little bit about 179D. That's a deduction for the construction of energy efficient commercial real estate. Then we'll touch on 45L, which is a similar program that the government puts forth for the construction of energy efficient residential units. So that's actually a credit. The 45L is a credit, not a deduction, where the 179D is a deduction. But those are probably two of the most underutilized credits and deductions that are available in real estate. And so we'll just touch on those briefly, and then we'll dive into cost segregation. I imagine a lot of you guys who own properties have probably heard of cost segregation, maybe are familiar with the term. We'll dive a little bit deeper talk about some of the additional benefits other than the accelerated depreciation, but we'll go into that when we get there. So just a little bit about us. As Toby mentioned, we've completed over 20,000 studies, actually about 28,000 studies, been in business since 2006. Do studies in all 50 states, and as I mentioned earlier, even some foreign countries, depending on where your properties are. So if you've got properties on the beach in Mexico, we love to do those, and I'm willing and able to go do those site visits myself. So definitely reach out. Our reports are engineering-based reports, so there's different types of reports in our industry. We'll talk a little bit about that when we get to the audit guide here towards the end. But we do engineering-based studies. Our reports were designed by CPAs for CPAs, so it's very easy. We partner with your tax preparers to get these inputted into your returns. And so with that being said, we'll go ahead and get started. As far as the 179D, as I mentioned, the 179D, you got to remember that the government uses the tax code to incentivize behaviors that they're trying to accomplish. And so one of the initiatives the government is trying to accomplish, obviously, is green energy. And so they've put out a tax code, it's called 179D, that allows you to take a deduction if you're building energy efficient commercial buildings. So they don't have to be from ground up. You may be doing tenant improvements. The 179D is only for commercial, so just keep that in mind. If you're doing residential, we'll get to that here in a second with the 45L. But the 179D could be for ground up construction. It can be for tenant improvements. And basically what we're looking at is three different components. The building envelope, which is the outside of the building, the insulation, the windows, the insulation in the attic. We're looking at the heating and air, the mechanical, and then we're also looking at the lighting. Those are the three big factors. There's a lot of other factors that go into it. But basically you have a third party come in, look at the building to determine if it meets or exceeds the IRS's standards. Now, if it does meet or exceed those standards, you may be eligible for a deduction based on the square footage of the building. So we'll get to the numbers here in a second, but to be eligible for that deduction, you have to have basis in the property at the time of construction. So a lot of times people will say, hey, I bought a brand new building. Am I eligible for the 179D? And the answer usually is no. That's because the developer who had the construction loan, who built the building, they would be the ones who are eligible, not so much the end user, the person who bought it on the investment side. Now, that would be different if you are an investor and you pay a contractor, you go take out a construction loan, you pay a contractor and say, hey, I want to build this medical office. Here's my specs, here's my blueprints. In that case, because you're carrying the construction loan, then you would be eligible for the deduction. So I always like to think of it as who is the person who decides what type of windows, what type of insulation goes into the building. And that's typically the person who's paying for it, and they are the ones who are eligible for the deduction. Now, if you are a builder, an architect, an engineer, you may be eligible for buildings that you have put work into that are tax exempt. So if you're building schools or designing schools, you may be able to be eligible for that deduction as well. And so there's some specifics that need to go into that. We can touch on those offline, but keep that in mind as well. If you're helping build nonprofit buildings or buildings that are owned by nonprofit companies, you may be eligible for some of that deduction. So the nice thing about 179D is you can actually go back as far as 2005. So if you've built any buildings or made significant improvements to any commercial buildings since 2005, you may be able to go back, take advantage of these deductions, and drop all of those deductions on your current tax return without having to amend any prior years. So that's one of the great things about 179D is the ability to go back. Now you'll see this chart here over on the right-hand side. The deduction has varied from year to year, depending on inflation, depending on the tax code at the time, but anywhere from $1.80 back to in 2005 through 2020, all the way up to $5.65 per square foot. So again, just remember, this is a per square foot deduction. Now, for those of you that don't know, deductions come off of your taxable income. So let's say I make $200,000 a year and I've got a $50,000 deduction. I get to take that off of my taxable income, and now I'm only taxed on $150,000 versus $200,000. So very powerful stuff. Again, extremely underutilized in the real estate world. A lot of the reason I think it's underutilized is tax preparers don't always know if these programs are on or off. The IRS used to allow these to expire, and they wouldn't reinstate them till the end of the year or maybe even the following year. And so it's just something that goes underutilized. I kind of think of your typical CPA or EA as kind of a general practitioner. They know a little bit about, a wide array of tax subjects. There's thousands and thousands of pages of tax code. They have to know a little bit about each of those different subjects, where we just dive deep into depreciation and energy credits. And so that's why we partner with your tax preparer on this stuff. It's not that they're incompetent, it's just that they don't know about all the changes and can't be on top of all the changes that are constantly happening. So very powerful stuff on the 179D side. Some things to think about, as I mentioned, you don't have to amend your returns. If you've got properties that were placed in service all the way back to 2005, you may be able to take advantage of this without having to amend and drop those deductions on your current tax return. What types of buildings would qualify? Just remember, it has to be commercial. And typically, depending on the year it went into service, I would say over about 20,000 square feet in order for it to make financial sense. Anything under that may not make sense because you do have to pay, obviously, to get the certification done. And so we just want to make sure that the tax savings is going to outweigh what the fees would be to get that certification completed. What years can you take the 179D? Remember, you can go back as far as 2005 all the way to current. With the now I'm drawing a blank. The most recent tax bill, it's not the most recent. It was the tax bill that the CARES Act. With the CARES Act, they extended the 179D permanently. Now, what that means in IRS terms is until we get a new administration or until they decide to change their mind. But the nice thing is this was extended permanently. And so that allows your tax preparers to be able to plan for using some of these deductions. Is it an all or nothing deduction? It depends on the year your building went into service. You may be able to qualify for a partial deduction depending on the year your building went into service. So keep that in mind. Maybe you went in and replaced air conditioners in a commercial building and replaced the lighting, but didn't do anything to the insulation. If the building went into service within a certain time range, you may be able to qualify for a partial deduction and take advantage of that. And what documents are needed for the 179D? We'll always do a free analysis before we ever engage a client to do the 179D. So we just need a copy of your blueprints. If you've got a complete set of prints, that usually gives us all the information we need to be able to determine whether or not we think it's going to qualify for some or all of that deduction. So that's the 179D, again, mainly for those of you who are building or improving commercial real estate. All right, so let's change gears now. Let's talk about the 45L tax credit. So again, remember that—
Real quick, sorry to interrupt you, Eric.
We're good.
Just because there's a couple of questions on the 179D, and I know that if we wait till the end, it'll get confusing.
Sure.
There's a couple of them. Does ground up include construction of short-term rentals?
If they're being treated as commercial properties, then yes.
And what does it mean?
The problem with short-term rentals is usually the square footage doesn't make sense to pay for a 179D certification unless it's a very large short-term rental.
It is commercial dependent on the number of units then?
No, it's based on how it's being reported. If it's being reported as a 39-year asset, then it's eligible for the 179D.
And just so you guys know, short-term rentals are treated as a 39-year property. So the answer would be, if it is truly a short-term rental, which is 7 days or less, it's going to be treated as a hotel property. It's going to be treated as commercial. Somebody says, is it something like multifamily, 5 units or more considered commercial? I think it is. Was it 4 units? But
it is for the 179D. It's a little bit of a different definition. If the multifamily is 4 stories or greater, then it is eligible for the 179D. If it's 3 stories or less, it's only eligible for the 45L. So there's a little bit different. There's some nuances there.
Okay, so it's not the number of units; it's the number of floors. Okay.
Yeah. Yep.
Fair enough. And guys, You can always use the link I provided you and ask these questions directly of an expert. Cool. I'll get
That's
out of here.
okay. Sounds good. All right. So let's talk, as I was mentioning, the 45L, remember the government uses the tax code to incentivize us to do what it is they want. And with green energy, they're looking for green energy homes. Therefore, they've got the 45L tax credit. Now, this is a credit, not a deduction. This comes right off the top of your tax bill. It could be anywhere from $500 all the way up to $5,000 per unit. So similar program, we're looking at the same types of things. We're looking at the insulation in the walls, the attic, the windows, heating and air, the lighting. The 45 value can't go back as far as 2005 because you would have to amend. So you can only go back as far as your open tax returns, which is typically 3 years. So you could go back 3 years. So if you've built any residential units in the last 3 years, you may be eligible for this credit. Now, a residential unit, according to the IRS, has to have four things. You have to have a place to eat, a place to sleep, a place to prepare food, and a place to use the restroom. And so student housing, senior housing, single family homes, multifamily are all eligible for this 45L tax credit. Again, as I mentioned, the credit can be anywhere from $500 to $5,000. It depends on the level of energy efficiency. You do have to have a third party come in and perform that certification. There's certain qualifications they have to have. They have to have a resident certified, resident certification in order to create the certificates. They're going to put in all this information into some modeling software that's approved by the IRS, and then it's going to spit out and say whether or not the buildings are considered energy efficient by their standards. Along with the 179D, the 45L, you do have to have basis in the property at the time of construction. So if you are buying, let's say there's a builder out there, they're building some turnkey fourplexes, and you go buy a fourplex, you're probably not eligible for the credit. It would be the builder or the developer who built those who carried the construction loan. Now, that would be different if I am an investor and I go have a contractor say, hey, I want you to build me a fourplex. I'm going to go get the loan. I'm going to pick out what type of windows, what type of insulation goes in the building. Then I would be eligible for this credit. Remember, that credit is per dwelling unit. So it could be, on a fourplex, it could be a $20,000 credit if it's built to certain standards. And I will say it's kind of hard not to qualify for these 45L credits. With the building codes that most counties have now and the materials that are being used, most oftentimes these buildings do qualify for some or all of these credits, depending on whether it's 179D or 45L. So just keep that in mind. It is kind of hard, like I said, not to qualify for at least a partial deduction or credit, depending on which program we're looking at. I mentioned this already. You've got to have basis in the building at the time of construction. That's an important key. Sometimes we get calls where people are like, hey, I just bought a brand new home. Well, if you didn't build that home, if somebody else built that home and took out the construction loan, it's not so much who built it, it's who carried the construction loan at the time of construction. So just keep that in mind. Here's a quick case study. These were 50 qualified units. You can see the dramatic difference in 2023. It nearly more than doubled the amount of credit if they qualify for the highest level. So in this case, there was 50 homes that qualified for a $5,000 credit. That's a $250,000 tax credit. Now, it is a non-refundable credit, but it does carry forward indefinitely. So if you don't have a $250,000 tax bill this year, maybe you only have 150, you would wipe out that tax bill and carry forward the $100,000 credit. Those same units, if they had gone into service just 1 year earlier, would have qualified for a $2,000 credit per home, so $100,000. So you can see with the tax changes of recent, the credits have more than doubled in some cases, depending on the level of efficiency in the homes. Can a remodeling project qualify? Just some things to consider. Yes, it can. Toby and I were talking about this earlier. It is sometimes difficult, though, on a remodeling project on 45L, because you have to go in and basically take the units down to the studs. But if you go into a building, take it down to the studs, put in new insulation, new windows, new heating and air, new lighting, then it certainly can qualify. But if you're just going in and giving it a quick facelift before you put it up for rent, you're maybe replacing some flooring, maybe some appliances. Even if you put in energy efficient appliances, that's not going to be enough to move the needle to be able to qualify for this credit. So typically it's only on projects that are taken down to the studs. Can I apply for this credit for past properties I've built? The answer is yes. But remember, you can only go back 3 years on the 45L. I can't tell you how many times we've presented this across the country to builders who are unaware of the 45L. They build hundreds of homes a year and never heard about this. Again, very underutilized. It's kind of a use it or lose it program. And so if you don't use it within that 3-year window, it will go away and you can't get it back. And there is no maximum number of units that you can claim the credit for, which is good. So one last case study. This is kind of what Toby and I were talking about a moment ago. This is a case study where the building happened to be over 3 stories. And so we were able to get a 179D deduction at $5.36 for the 88,000 square feet. So that created a deduction of $473,000. And then just the credit alone on the 155 units was another $775,000 credit. So remember, we're taking the 775 off of our tax bill and then reducing our income by 473. So this client is not going to have to pay tax for the next couple of years, to say the least. So in this case, you can see where we've coupled both these programs and we're able to create a massive deduction and a massive credit. And on top of this, we didn't even do the cost seg study yet. That's something we're going to do in future years because they don't need any additional deductions this year because of the credit and the 179D that they've got. So with that, we'll go ahead and transition into cost segregation. Toby, are there any questions on that?
Yeah, there's so many questions that have been flowing in. And guys, we're not talking about solar tax credits today. I've got a whole bunch of people asking me about, what if I buy a house and get a solar unit? Stop it. Not talking about that. And I'll answer your questions as I go through it. But for multi-unit dwellings, 2, 3, 4-plex, is the credit available for each unit, or is it just the building in its entirety?
The credit is available for each unit, so it's per door credit. So again, that could be up to $5,000 per door.
Yep. And what about an ADU on a primary residence?
ADUs do qualify as long as they meet the specifications.
Are modular homes out of the question if you have green energy options when ordering?
They're not completely out of the question, no.
So it's possible. And by the way, again, I gave you guys a link. Anderson Advisors, they'll share it out again. If you have these types of questions, you want to apply them to your personal circumstances, reach out to them. They don't charge you for it, right? So like, not to, because I want to dump a whole bunch of people into on Erik and have you answering questions for the next 3 days, but because it's always facts and circumstances. What if it's a 1-bed, 2-bath condo that I own and rent out? Could it qualify?
If you built that condo, yes. Remember, this is for new construction or heavily remodeled construction. So
Yeah, so you have to have revamped it.
correct.
Do new windows fall under the qualifications?
New windows do, but it's looking at the building as a whole. So new windows will help your overall rating. But if you just put in new windows and you've got the original insulation and the original lighting in the building, then it won't qualify. So this is a credit. Remember that is for, we're looking at the entirety of the building, that whole unit, that whole residential, or what the IRS calls a dwelling unit, has to meet certain qualifications. So yes, if you put in windows, that would help, but windows alone would not get you the credit.
Okay, what if it was a townhouse, 2 floors, new construction, went into service in 2022? Can I still take advantage of this?
Yes, if you took out the loan to build that townhouse, if you bought that townhouse from a developer who built a bunch of them, then the developer is the one who's eligible for the credit, not you.
Unless you completely gutted it and redid it, right?
Yep, correct.
Right. So if you took it down to the studs, let's just put it that way, and redid it, then you could get it. Otherwise, you had to have built it. And then what about a product like Boxable? It sounds like an ADU.
Yeah, it depends. Sometimes the folks who manufacture those are the ones who are eligible for the credit. So it depends. Those are, if that's what they're referring to, then it would depend.
Does how it's titled matter? We have 2 in our personal names and 1 in a company name.
No, the way it's titled doesn't matter. As
Doesn't
long as,
matter.
yep.
Yeah. If you're the investor and the contractor does all this for you, do they get the credit?
No, not if you took out the construction loan. So that's the most important piece. That's where a lot of confusion comes in. You've got to have basis in the property at time of construction. So if you took out a loan and called the contractor and said, "Hey, I just took out a loan for $1 million. I want you to build me a fourplex." It doesn't matter who does the work because you took out the loan and you're deciding what type of heating and air, what type of insulation, what type of windows. You're the one eligible for the credit. The difference there being if I'm a developer and I build a bunch of fourplexes, then I sell them off to investors. Because I took out the construction loan, I would be eligible for those credits in that scenario.
All right, there's so many questions. I'll stop here in a second, but does the ADU have to be three stories? I think they're mixing the 179D and the 45L.
Yeah, no, it doesn't. So 45L, there's no story limit or anything. It could be a Rambler. It just has to meet that definition of a dwelling unit, those four criteria.
And remember, 45L is a tax credit. It's worth cash to you. 179D is a deduction. It just offsets your income. So like the 45L is worth like 3 times, you know, 4 times what that deduction is worth. Somebody says, what if I pay cash for a project? Somebody else also asked if they don't have receipts.
You
What
don't
are they?
have you don't have to have receipts. But like I said, you would have to do substantial. So if you went in, sometimes people say, well, I went in, put in some energy efficient appliances, maybe change the windows out. Again, for the 45L, you're going to have to do a complete gut job. You don't have to have receipts. If you go in, let's say I buy a residential unit for 300,000, I spend 100,000, I gut it, I put in new insulation, new windows, new lighting, new HVAC. You don't have to have receipts. We just need to know model numbers and that type of thing. And then we can run the analysis to see if it qualifies. But no, you don't have to have receipts.
All right, I'm going to get out of your hair for everybody that's asking these questions then, because there's 3 of them right now. So if if you build the ADU and you didn't use financing, you could still do it. If you used it with cash, you could still do it. You don't need the receipts, you could still do it. At the end of the day, reach out to Erik with your scenario. And at andersonadvisors.com/CSA, Cost Seg Authority is what that stands for, because they will answer all these questions for you on your specific deal, because some of these people are coming back with 3 or 4 questions. All right, I'm out of your hair. Get
All
back.
right.
This is the fun one. Cost Seg's like rocking it right now the last few years.
Yeah, no, cost segregation is huge and it can be huge. So, what is cost segregation? That's a question we get asked often. And cost segregation really is just accelerated depreciation on your real estate assets. So, one of the benefits of owning real estate is we get to take a depreciation expense or a deduction off of our income every year. So, typically for residential units, that deduction is spread out over 27 and a half years. For commercial units, it's spread out over 39 years. So just to make the math easy, let's say you buy a property for 275,000. You're going to divide that by 27 and a half years. You're going to get a $10,000 write-off every year. Now, I've oversimplified that a little for presentation purposes because you don't get to depreciate your land. So you always have to back out the land value. But your purchase price minus your land value equals what we call your depreciable basis. And let's say your depreciable basis is 275,000 and it's a residential unit. You would divide that by 27 and a half. You're going to get a $10,000 write-off every year as a deduction. Basically, the IRS is saying there's wear and tear on your residential unit. And so it's not worth as much, even though the value has gone up, it's deteriorating, it's depreciating. And so you get to take that expense. So that's great. That's why a lot of us get into real estate. I'll take a $10,000 deduction every year. However, I'm not going to own my property for 27 and a half years, certainly not 39 years for commercial property. I want my deductions now. There's inflation, there's time value of money. There's a number of reasons why I want to increase or take as much of that deduction up front as possible. And the way we can do this is through an engineering-based study where we go into the property and say, okay, you bought this home for 275,000. But you also, when you bought that, you bought some carpet, you bought some countertops, you bought some window coverings, you bought a driveway, a sprinkler system, some appliances. All those things I've mentioned, the IRS says should be depreciated at a much faster rate. Carpet doesn't last 27 and a half years. According to the IRS, carpet is a 5-year asset. The problem is when you buy that building for $275,000, you give that closing statement over to your tax preparer, they have no idea that there's even carpet in the building, let alone what the carpet is valued at. And so just as the name implies, cost segregation, we're taking the cost of this building, segregating it into different buckets, which allows your CPA or your tax preparer to depreciate those assets at their correct useful life, which is typically much faster than the 27 and a half or 39 years. So how is that done? So when we go into a building, there's really 3 tests we're looking at. The first one is if the property can be removed without damage to the building or structure. So again, I can take the carpet off. I'm in an office building here. I can take the carpet up off the floor here and it's not going to damage the building or structure. I can remove the window coverings behind me and it's not going to damage the building or structure. So typically those are considered what we call personal property and they get depreciated over 5 years. The second is if the relationship between the asset and the equipment or machinery is so close, they would be retired at the same time. So you guys can't see here, but there's a TV up on the wall here in this conference room. That TV is a 5-year asset. But not only is that TV a 5-year asset, there's a plug mounted in the middle of the wall that is specific for that TV. There's conduit that goes through that TV or to that TV that is specific for that TV. So not only is the TV a 5-year asset, everything associated with that TV is also a 5-year asset. So if you think about a multifamily building, how much of the electrical work that goes into multifamily is specific for short-term assets? Things like garbage disposals, ceiling fans, appliances. Sometimes it can be as much as 50% of the overall electrical work going into that building is specific for short-term assets. We get to put a value or a cost to that electrical work all the way back to the circuit breaker, and we get to associate that with the short-term personal property asset, which allows us to depreciate that at a faster rate as well. And then the third is if the relationship between the asset and the nature of the business are unique. I'll give you an example. An example I like to use is we did a cost segregation study on a meadery down in Arizona. A meadery is a place that produces mead, and mead is a fermented honey. So they take honey, they ferment it, and it creates kind of a honey wine or a honey beer. And we went down to Arizona. It was in the middle of summer. It's like 120 degrees. We go into this warehouse, and they've got all these 50-gallon drums of honey, and they've got these specialty HVAC equipment that's keeping this honey at a certain temperature. Now, normally HVAC equipment to keep you and I cool, the HVAC in this building, is part of the building. It's not short-term assets. Because this HVAC was used specifically to keep their honey cool, because, you know, honey, when it's 120 degrees, can be very runny and very hard to work with. Because this HVAC equipment was specific to keeping the honey cool, we were able to reclassify that as equipment and depreciate it over a much faster useful life. So those are kind of the 3 criteria that the IRS has put forth that we use when we determine what is considered short-term assets. Now, here's a list of some short-term assets, some commonly segregated items. Over on the right-hand side, you have your 5 and 7-year buckets, your 5 and 7-year assets. Those are things like carpet, countertops, cabinets, parts of the lighting, parts of the plumbing, window treatments, wall covering, removable flooring. Those are all considered mostly inside interior stuff are your personal property assets. Outside, we have what we call land improvements. Those are all of our 15-year assets. Things like parking lots, curbs, gutters, asphalt, storm drains, irrigation systems, retaining walls, trees, bushes, and shrubs is kind of an interesting one. We'll actually go out and count all the trees, bushes, and shrubs around your property. The IRS says that those last 15 years, and they should be depreciated over 15 years, not 39 or 27 and a half years. So we'll put a value to those. Everything that's left over, which is usually about 70%. So just keep that in mind. When we're doing a cost segregation study, we're going to take usually, depending on the asset class, around 30%, move it into these short asset classes. The other 70% stays in that long-term real property category. Things like the steel structure, the roof, the walls, the doors, the windows, etc. So remember, about 30% is usually what we're segregating. You know, Multifamily, we might get 35, 40%. Maybe if it's just an empty warehouse, we might get closer to 25%. It just depends on the asset class, but usually right around 30%. So that's kind of cost segregation at a high level. Remember, we're just taking these buildings and breaking them up into different parts, putting values to those different parts that allows our tax preparers to depreciate them at a faster rate. With cost segregation, there comes 4 additional benefits. One is bonus depreciation. Toby mentioned earlier that there's some tax laws going through Congress right now that will impact that or should impact that. We'll talk about what bonus depreciation is, how it works, and what the changes are that we expect to be coming. Catch-up depreciation, that's the ability to do cost segregation on assets that have already been placed in service without having to amend, which is great. Reduction or recapture on sale. This is one that oftentimes goes overlooked by tax preparers. But when you do cost segregation, you can actually create a permanent tax savings when you sell the building. And we'll just have a quick example of that. And then if we have time, we'll talk about partial asset dispositions and 179 expensing. So here's a case study. This was bought for 1.3 million. That doesn't include the land. Remember, land is non-depreciable. So just the building itself was 1.3 million, put in service in 2023. The current tax year is 2023. We went in, we identified the short-term assets, the flooring, the cabinets, countertops, the electrical, retaining walls, etc. And here's what we came up with. So I know these numbers are small. Hopefully everyone can see them okay. I'm going to see if I can pull up the laser pointer here. But over here on the left-hand side, this would be your depreciation without cost segregation. So you take the 1.3 million, you divide it by 39 years, and essentially you're going to get a $33,000 write-off every year for the next 39 years. Now, the first year you'll see it's an $18,000 deduction. That's because there was just a partial year of ownership, so you don't get the full amount. But essentially you're getting the $33,000 write-off every year for the next 39 years. In this section here, you can see this is where we've done a cost segregation study. So we've taken that $1.3 million, we've split it up into these different categories, and we started depreciating them over 5, 7, and 15 years. So in this case, I don't have the numbers across the bottom, but I believe we segregated 31% in this example. And so we take the 5-year assets divided up over 5 years, 7-year assets get split up over 7 years, 15-year assets get split up over 15 years, and here's our new depreciation numbers here on the right. So now we're getting a $56,000 deduction in year 1 versus an $18,000 deduction. In year 2, which is our first full year of ownership, we're now getting a $97,000 deduction versus a $33,000 deduction. Now, what you can't see here on the chart, it's actually, I believe in year 2039, you're actually going to get a $30,000 deduction versus a $33,000 deduction. But I'm okay with that because I've had all this tax savings in the first 15 or so years to be able to pay down my debt, to reinvest, to go buy a new property, etc. So again, all we're doing is front loading our depreciation in these early years and getting less deductions in these future years. At the end of the day, if you were to hold this building for 39 years, in either scenario, you're still getting $1.3 million of deduction. It's just by doing cost segregation, we're front loading it or taking it at a faster rate. Again, number of reasons why you want to do that: inflation, time value of money, etc. So in this example, by increasing the depreciation in the first 5 years by $194,000, that created a $68,000 tax savings. Now that was, I believe, calculated at a 30% combined state and federal rate. So pretty powerful stuff. Now that's not even using bonus depreciation. That's just straightforward cost segregation, just accelerating those deductions forward. Let's talk now about bonus depreciation. So bonus depreciation has been around for a number of years. The IRS uses bonus depreciation to stimulate the economy. So if the economy is not doing well, they'll increase the bonus percentage. If the economy is doing well, they'll lower the bonus percentage. But essentially, bonus depreciation encourages people to go out and buy stuff. So if we go back to 2017, the end of 2017, bonus depreciation at the time was at 50%. and it only applied to brand new purchases. So you had to go buy a brand new bulldozer. You couldn't buy a used bulldozer. You had to buy a brand new bulldozer. And if you did, you were eligible to take 50% of those deductions in the first year. So let's say you buy a $1 million bulldozer, you would get a $500,000 write-off in the first year. The other $500,000 that was left would get spread out over the useful life of that bulldozer. So that's great. Fast forward to the end of 2017, like I said, Donald Trump was our president. Donald Trump owns real estate, and Donald Trump revised the tax code. So with the Tax Cuts and Jobs Act, a few things changed. One is bonus went from 50% to, as you can see here, 100%. Any assets bought between 9/27 of 17 and 12/31 of 2022 are eligible for 100% bonus. Oh, give me 1 second here. Sorry, my computer just told me my battery's going to die. So let me plug that in. There. So as you can see, 100% bonus. Now, 100% bonus. Toby, can you see that okay? Did
I
that?
can't. Yeah, what are you looking at?
Oh, no, I just wanted to make sure I plugged my computer in and it pulled up my other screen. So I just want to make sure you can see me okay.
Oh, I can see you okay. Hey, everything looks good. I see a little
Okay.
red too. Everybody's giving you a thumbs up too.
Okay, perfect.
These guys
I've
are
got
making fingers
I've got
burn.
two cameras, and so I just don't want to look up at this camera when I'm looking at this screen. So as long as you guys can see me okay, that's good.
It's on your computer camera, by the way. Like it's not the one that's above.
Gotcha. Okay, perfect. So I'm looking, we're good.
Yep.
All right, so back to bonus depreciation. So bonus depreciation, as I stated, it was at 50%. With the Tax Cuts and Jobs Act, it moved to 100%. So any assets placed into service between 9/27 of 17 and 12/31 of 2022 were eligible for 100% bonus. Now, anything put into service last year, it dropped to 80%. Next year, it's on schedule. Excuse me, this year it's on schedule to drop to 60%, then 40, then 20, then 0. In saying that, there is a bill in Congress, as Toby mentioned earlier, it's already passed the House, it's just sitting in the Senate right now, that is going to extend the 100% bonus through 2025. So this phase out period here will be eliminated, and we'll just have 100% bonus all the way through 2025, which would be great. So we'll keep an eye on that. They were actually supposed to make that, they were supposed to have that decision made by the 29th because that was the open of the tax season. That didn't happen. And so they're kind of behind the clock now because people can technically file their 2023 taxes. And we still don't know if we should be applying 80% or 100%. I do anticipate that the 100% will get passed. The reason for that is it's got bipartisan support. It was kind of attached to the child tax credits. So the Democrats wanted the child tax credits. The Republicans wanted these business for this bonus depreciation, and they kind of married the bill together. And so it's got bipartisan support. It should get passed. We just need them to get back together and get it passed as soon as possible. So what does bonus depreciation mean? What that means is when we do our cost seg study, any of those 5, 7, or 15-year assets, so bonus only applies to assets that have a useful life of 20 years or less. So if you don't do cost segregation, your asset is either a 27.5-year or a 39-year asset, which means it's not eligible for bonus. With cost segregation, that 30% of that 5, 7, and 15-year stuff that we typically find all of a sudden is eligible for bonus. So let's see what that does to that same case study, but now we're going to apply the 80% bonus. So remember, we have our 1.3 million, we divided it by 39 years, we're going to get a $33,000 write-off if we don't do cost seg. If we do cost seg, we're going to take 80% of these 5-year assets all in year one. So you can see that's why there's such a big number here in year one, because we're getting 80% of these deductions in year one and spreading the remaining 20% over the next 4 years. Our 7-year assets, we get 80%. Our 15-year assets, we get 80%. And now we're getting a $350,000 deduction in year one versus an $18,000 deduction. Now, if this building had gone into service in 2022, you would actually get all of this deduction in year one, all of this deduction in year one, and all of this deduction because you would be eligible for 100% bonus. So this is the way the law currently reads. if this bill does get passed, this would be 100% bonus. And as I mentioned, you'd get 100% versus 80. But even at 80%, look at what this deduction does. It's a $350,000 deduction versus an $18,000 deduction, which is an increase of depreciation of 331. That's about $132,000 of tax savings. Now, if you can't utilize this deduction, let's say I make 150,000 this year. I don't need a $331,000 deduction. I can do one of two things. I can take the full amount, wipe out my income. The remaining, what is that, 180,000 or so would just carry forward to the next year. That's one option. Or I can actually opt in or out of bonus depreciation by these class lives by the 5, 7, and 15. So we'll have some investors say, I don't want to apply bonus at my 5 or my 7 year. I do want to apply bonus at the 15 year. And what that does is it spreads out these deductions a little more equally instead of taking such a huge number in the first year. So sometimes folks will do that as a tax planning tool because it doesn't always make sense just to wipe out all of your income, because then you're utilizing these deductions against income that's being taxed at a lower tax rate. So sometimes it makes sense. You want to use these deductions to manage your tax brackets. And so just some different options there. Now, on that note, we should bring up that these deductions, this $350,000 deduction, is typically considered a passive deduction and can be used to offset passive income. So you've got passive income and active income. These deductions typically are considered passive and can be used to offset other passive or rental income. Now, a lot of you have probably heard about real estate professional status. If you have real estate professional status, meaning you spend the majority of your time doing real estate and at least 750 hours a year, then you may be able to use these deductions to offset active or W-2 income for you or your spouse. But you would need to be able to qualify yourself as a real estate professional status. There's some other ways to utilize these against active income. There's something called a short-term loophole that maybe you guys have heard. I know that's a very popular strategy right now. When you buy a short-term rental, if the average stay is less than 7 days, if you materially participate in the management of that property, oftentimes that will be considered a 39-year asset. As Toby mentioned, it's treated more like a hotel than it is a residential rental. And in that case, those deductions can be used to offset active income because you're actively participating in the management of that hotel business. So there's some different ways and strategies, but definitely want to consult with your tax preparer before doing a cost sake study to make sure, hey, these guys can generate a $350,000 deduction. Can I, in fact, utilize that to offset offset income? So all right, so let's talk now about catch-up benefit. I mentioned this earlier a little bit, but catch-up benefit is the ability to do cost segregation on assets that have already been placed in service. So let's say you're hearing about cost segregation for the first time today. You met with your tax preparer. You're going to have a big tax liability for 2023, but you've owned some properties since, let's say 2015. So you've got some properties that are already on your tax return. You can actually go in, do cost segregation on those assets, take all that missed depreciation, bring it forward into the current year without amending your tax returns. So again, that's called a look back or catch-up study, but the IRS allows you to do that. It does require an extra form. It's called a 3115 or a 3115. On that form, all we're doing is telling the IRS, here's how much depreciation I was eligible for once I did the cost seg study. Here's how much I've taken, and here's the difference in those numbers. And that's the 481A adjustment. So it's kind of interesting. When you fill out that form, we actually provide that form as part of the services that we offer. But when we fill out that form, we're checking a box that says we're going from an impermissible method of depreciation to a permissible method. Basically telling the IRS, hey, I screwed up. I was depreciating my carpet over 39 years or 27 and a half years. It should have been over 5 years. And here's the difference in those numbers. And so there's a lot of numbers on here. It's a little bit blurry. I apologize. But this is a page from one of our reports. This is that same retail building, but now we're showing it as if it was placed in service in 2015. So we've got our $1.3 million deduction. From 15 to 2021, we took $437,000 of depreciation. We were eligible to take 200, excuse me, I got those numbers backwards. We were eligible to take 437,000 once we did the cost seg. We took 218,000, which means we were eligible for a change of an additional $218,000 of depreciation. So here's the depreciation that was allowed through 2021. Here's what we took through 2021, and here's that difference in those amounts. And we get to take this whole 218,000, drop it on the current tax return, again, without having to amend. All right, so let's talk now about the sell of an asset. This is probably the most complicated concept we'll cover today. I'm going to try and keep it as high level as possible. But the idea here is when you sell an asset, you pay two types of tax. You pay capital gains tax and you pay depreciation recapture. And depreciation recapture is based on how much depreciation you've taken. So oftentimes tax preparers, investors will say, Erik, why am I taking all this depreciation up front? Doesn't that just mean I have a bigger tax bill when I go sell the asset? And the answer is no. You do have to pay some of it back, but you're paying it back at a lower rate on a lesser amount and saving the spread. And so again, the idea is take your deduction today against your ordinary income. So let's say I'm in a 35% federal bracket and a 5% state bracket. So I'm going to take my deduction at 40% this year. I'm going to pay it back, some of it back, not all of it back. I'm going to pay some of it back at a lower capital gains rate of 20%, or at most a recapture rate of 25% and save the spread. And so here's an example. Here's an example of what that might look like. Now, I know there's a lot of numbers here. It took me 3 weeks to figure this slide out, so I don't expect you to figure it out in the next 30 seconds. But the idea here is we've got our building. This is that same retail building, our $1.3 million building. We sold it 7 years later for $2 million. So it went up in value. We sold it for $2 million. If I don't do a cost segregation study, my total tax bill on that transaction is $198,000. Now, I don't show all the math here, but that's your capital gains tax, that's your recapture tax, $198,000. When you do a cost segregation study, remember I owned the building for 7 years. I had $145,000 worth of 5-year assets. What is the book value of those 5-year assets after owning the building for 7 years? They have zero book value. My 7-year assets have zero book value. They've been fully depreciated. Now, my 15-year assets, they have some book value. Obviously, my 39-year assets have some book value. When these numbers flush out, when I take my capital gains and recapture tax here, my total tax bill now is $164,593. So I just created a permanent tax savings of $34,109 by doing cost segregation on a building that I sold 7 years later. So I know there's a lot of number there, so I'm going to give you one more analogy that I think is a little easier to understand. Let's say I bought this office building I'm in today for $1 million. 5 years later, I sell it for $2 million. So everything is doubled in value. So when I settle up with the IRS, I'm saying, hey, I bought all this stuff here for $1 million. I'm selling all this stuff for $2 million, and they're going to charge me tax on that $1 million of gain. Well, my land has gone up in value. My walls have gone up in value, but certainly my dirty, nasty carpet that's 5 years old is not worth double what I paid for it. The problem is when you don't do a cost seg study, you don't know the value of that original carpet because everything is just lumped together as building. And so we don't have everything broken out. So again, in that example, what is carpet worth after owning it for 5 years? It's worth nothing. It's got zero book value. So why are you telling the IRS that it's doubled in value and paying tax on that? And so that's the whole idea. Take your deduction at a high rate, pay back a portion of it at a lower rate at a future date, and save the spread. And that's really what we're trying to accomplish with cost segregation. So here's a summary of the 4 different case studies we did. In each case, we saved anywhere from $34,000 in tax savings all the way up to $112,000 in tax savings when we applied bonus. So $66,000 on the original cost seg study. When we applied bonus, it went to $112,000. And then in that lookup or that catch-up study, we created a $93,000 tax savings. So it's not a matter of if you should do cost segregation. Typically, it's a matter of when. And that's a conversation you want to have with both us and your tax preparer to say, hey, I've got these deductions available to me through my real estate holdings. When is the best time for me to implement those or activate those deductions to maximize the amount of tax I'll save? And so that's a conversation that we typically will have with your tax preparer, with you to strategize on how to maximize those. All right, so let's talk quickly about partial asset disposition. I know we're just about to the top of the hour here. Partial asset disposition, that's one of the added benefits of cost segregation is when you dispose of part of your building or replace part of your building, you get to take the remaining book value of that item, dispose of it, expense it in the current year without having to pay any recapture tax. So I'll give you an example. Oftentimes we'll see a client go in and replace a roof. So they buy an apartment building, they go in, they put a new $100,000 roof on that building. Well, the old roof on that building still has some book value. And so you should pull that old roof off the building, expense it, and put the new roof on and start depreciating the new roof with a new in-service date. And what we see happen all too often is we get depreciation schedules that say, hey, I've got a building, and then 3 years later, I've got a new roof. And you're depreciating, in that scenario, you're depreciating two roofs at the same time. You've got the old roof that's stuck in that line that says building. You've got the new roof, and now we're depreciating two roofs at the same time. When you do that, you unintentionally, artificially inflate the amount of recapture tax you pay because you're taking too much depreciation. You're depreciating two roofs. You should only be depreciating one roof, but you don't know the value of that old roof that's stuck in that building line, so you can't pull it off. And so that's one of the added benefits, that as you're replacing different components of your building, if you know what the old component costs, you can pull that out, expense of it, and pay no recapture tax. So just one of the added benefits. Now you can do this without doing cost segregation. It's just very complicated for your tax preparer to figure out. But when you have a cost segregation study and you have everything line itemed, as you go replace the cabinets, you just pull the old cabinets off and dispose of it. As you go replace the roof, you pull the old roof off, dispose of it. And so that's just, again, one of the added benefits, one of the added tax saving strategies when utilizing cost segregation. All right, so some things to think about regarding cost segregation. What types of properties are worth looking into? Really, it's any revenue generating property, so any type of investment property with a basis of about $200,000 or greater. So the reason the basis needs to be at least $200,000 or greater, if it's less than that, oftentimes the tax savings, unless you're in a really high tax bracket, the tax savings may not outweigh what the fee is to get these studies done. So as I mentioned, fees, we should probably talk about that. The fees on these can be anywhere from $3,000 up to $30,000, depending on the size and scope of the project. So we want to see at least a 7 to 10x return on that. So if we're charging you $3,000 for a study, we want to see you save around $30,000 in taxes. And that can often be met by utilizing some of these strategies such as bonus depreciation, et cetera. So that's kind of a range. I know that's a wide range. Our average study is somewhere around $4,000 or $5,000. Again, just depends on the type of asset. You know, single family rentals are closer to 3, large office buildings are closer to 10. And so we kind of average there in the middle. But when does it make sense to do a cost seg study? Anytime you own real estate and you have a tax liability, you should at least have some numbers run. So we'll always, as Toby mentioned, I think with the link that Toby has put in the chat, we'll always do that analysis, that free analysis for you, so that we can determine if the property makes sense. So we'll come back and say, hey, on this building, you're going to save, $80,000 in taxes. It's going to cost you $3,000 to do the study. In that case, it absolutely makes sense, and we move forward. What items do we need to provide that analysis? We just need a copy of the closing statement, or we may need a depreciation schedule if that building has already been placed on a tax return. So if you bought the building in 2017 and you've never done cost seg, a copy of your depreciation schedule would be helpful. If you bought the building in the current year, we would just need a copy of the closing statement. But again, feel free to reach out to us. We're happy to kind of walk you through what we need on on that to run the analysis. I'm just going to touch on this quickly because it's just 5 minutes past the hour, but I just want to make note here. Toby mentioned this in the beginning in the intro, but the IRS does have an audit guide on how these cost segregation studies should be audited by their agents. The audit guide hadn't been updated in a number of years. It was recently updated just a year and a half ago with some significant changes to it. The reason for that, I believe, is cost segregation has kind of been the wild, wild west for a number of years. There's a number of different methodologies on how to do cost segregation. There's different strategies, there's different ideas, different interpretations of the law. And the IRS, with bonus depreciation, cost segregation is becoming more and more prevalent. And I think the IRS wants to kind of standardize and put some guidelines around what these studies need to look like. So as Toby mentioned, we've done just over 28,000 studies. We've been involved in just over 20 audits, and not a single audit have we had to change our numbers. And that's because we follow the audit guide to a T. So it tells you the 13 steps to a quality report. We make sure that our report is in that same order. And that way, if and when these ever get audited, the IRS agent looks and says, oh, this was done by a reputable company. It's got all the information we need in it, all the backup documentation. And so, they move along their way. So our reports are anywhere from 40 to 50 pages. It's got a bunch of case law, a bunch of backup documentation, and then it's got obviously the numbers in there for your tax preparer. So that's the audit guide. Interesting here, the audit guide, these are the preferred method. There's different methods of doing cost segregation. There's online methods, those are kind of like the TurboTax of our industry. So they're usually cost less. However, the benefits are usually significantly less. Just last week, I had a client out of Colorado who used an online service, got the cost segregation study completed. The study was about $1,500 less than what we were charging. However, they only segregated 21%. This was a $700,000 asset. They segregated 21%. So if you recall to the previous slide, I mentioned that we typically segregate around 30% when we're doing an engineering-based study. That difference of 10% segregation on a $700,000 asset, that's $70,000 of additional deductions. Take that $70,000 times a 30% tax bracket, that's a $21,000 tax savings difference by doing an online study versus doing an engineering-based study. So in that case, the client actually paid for a second study because he was unhappy with the first study. And the difference between our fee and the $21,000 was $18,000 of additional tax savings. So again, there's different methodologies. You just want to make sure. I always recommend having the numbers run. It's really just a math equation. We're going to be a little bit higher in price if you do an engineering-based study, but if the overall tax savings is significantly higher, then it just makes sense. And so just keep that in mind as you guys are considering cost segregation. I would always recommend getting an engineering method done first. The reason for that here is down on that last one, it says rule of thumb approach, or what we call a modeling approach. An examiner should view this approach with caution since it lacks sufficient documentation to support the allocation of project costs. So not only are you getting less benefit, if and when it ever gets audited, it's going to be much harder to defend because those online methods are just using some averages. They're not actually going in and looking at how much carpet's in your building. They're not going in and looking at how many cabinets and countertops are in your building. They're just taking some averages. So just keep that in mind. I'm not going to go over this just because of time. I think that's everything, Toby. I know Toby put this link in the chat. If you guys have any questions, please don't hesitate to reach out. As Toby mentioned, we don't charge by the hour. We also don't do tax returns here. So please don't ask me questions about earned business income or child tax credits. I'm just going to refer you back to Toby. But if you have any questions about real estate tax depreciation, we're happy to help. Contact information is there. Thank you guys. And I know Toby's probably got some questions.
We got a ton of them. I've answered 151 and there's still 70 open questions. So I have a whole bunch flagged. Are you ready?
Yeah.
Now, some of these I could answer. I won't make you answer because you'll be like going, come on, guys, I answered that already, right? But some of these were asked an hour ago. Does it make sense to go through the expense of a cost seg on a mobile fix and flip? My guess is no, but wanted to ask. If you want to answer that, you can. Otherwise, I'm just going to say you don't get depreciation on a flip. So there's no
Correct.
such thing as a cost seg on a flip.
Correct.
Anything else you want to add on that?
No, just that the building has to go into service. So typically on a fix and flip, you're
Yeah.
buying it, you're fixing it up, and then you're selling it. It's never going into service. So one thing that people will do if they do need deductions is you can buy a building, fix it up, put it into service for 6 months to a year, depending on your tax preparer, what they're comfortable with. And then you can take the depreciation on it. But if you're just going to fix it, it's vacant, you flip it, you sell it, nobody ever lived there, then you don't get to take depreciation, which means cost segregation would not work in that scenario.
And you do have to be careful if you buy a house with the intent to sell it, and the only thing you do is you put it into service for 6 months to do that, the IRS could attack that saying you're a flipper and you get no depreciation and put it and say, add it to basis. And all you're doing is you're hosing yourself, right? Now, if you do the short-term rental issue, which is if you're renting a house out for 7 days or less on average, so you're doing Airbnb or VRBO, that's not passive activity anymore. That could be a active loss and can offset your W-2 income if you materially participate in that business. I know I just threw some terms at you, right? But what it is you could start, Erik's same example, you buy a house, you do a cost seg on it, and in that first year, even if it's just for a few months, even if it's for a month, right? You make it into a short-term rental and you handle all the rental. You act as the host, you do the cleaning, you do all that stuff yourself. That's an active ordinary loss. Then that cost seg will offset your W-2 income. We do this with doctors all the time. Is that either their spouse or themselves, they actually spend the time doing it because it's going to give you a huge tax benefit. Then you make it into a long-term rental, it doesn't matter. Anyway, I don't want to dominate this thing. If you are house hacking, planning to update the rooms, say redo the bathrooms, can a cost segregation be used?
Typically not. So bathrooms specifically don't get segregated. Bathrooms are part of the building. They're a long-term asset. But even if you were to go in and fix up a kitchen, for example, usually what happens is there's a de minimis value and you should just be writing that stuff off as an expense in most cases. So that de minimis value, I think, is $2,500. Correct me if I'm wrong, Toby, but oftentimes if you've got an invoice for less than $2,500, I would suggest just writing it off.
Writing it up. Yeah. Yeah, you're in the real property regs where you have a safe harbor. If you have your records being maintained for a lender, it's actually 5,000.
Okay.
So it can be yeah, and then it doesn't matter whether it's improvement. So if you're fixing up that bathroom, we might be able to write it off in another way.
Yep.
Hey, does this apply to syndicators?
It does, absolutely. So we work with a number of syndicators. We do the cost segregation at the building level, and then typically through the syndication, through the K1s, each investor will get their deductions on that K1.
Irene's asking me, do we do training for our tax preparers? Yes, in fact, Erik's team comes in and trains our tax preparers. We just did one.
Yeah, it was a week ago or a week and a half ago.
Yeah, so we actually do continuing education. We're trying, guys. Like it's so complicated. There's like you're just getting a taste of it. Like you're just taking a sip of water. These things get deep. And so we're always looking for facts and circumstances, but we need everybody to be on the same page so we can do it. Somebody was talking about their accountant saying, oh, he doesn't like cost seg, he doesn't think they're beneficial. What he's saying is, I don't really know, and I don't want to go through the analysis, or I've looked at 3 of them and they didn't help my client in those 3 cases, therefore we don't do them. And I'll just be straight with you guys. 3 rules, anything that's tax related, calculate, calculate, calculate. Just run the calculations, use that link, andersonadvisors.com CSA/CSA, and you do not have to pay to get the analysis done. We will work with them. Somebody asked, do you need their tax return in order to do the analysis?
Not typically, no. We need 1 page out of that tax return, which is the depreciation schedule. Sometimes people will just send us the whole return because it's easier than them trying to dig through it and find it. But typically, we just need the depreciation schedule. That's on assets that have already been placed in service. If it's something you recently bought, then we don't need the return. We just need the the closing statement.
Right. Somebody says, what's the future of 1031 laws? It's not a topic for today, but there's no question it's still there.
Yeah.
Yeah, real property survived. Everything else was removed from 1031 exchanges under the Tax Cut and Jobs Act. So yes, it's surviving. Can a mobile home with a title be cost sagged when purchased and used as a short-term rental? Or do we have to retire the title and attach it to the property to do the CS?
That's a good question. So it sounds like the mobile home was used for personal use and then they're gonna park it somewhere and use it as a short-term rental. Is that?
I know what they're doing. Is it being attached to a foundation or is it removable? In either circumstance, you can do the cost seg on them, right?
Yeah,
You're gonna write it all off as personal property if it's not attached.
right. So in that case, you don't need a cost seg study because you're just gonna write it all off with bonus depreciation.
Yeah, this is what's crazy. In some cases, you're writing off 90% of a purchase on a mobile home just to trip you guys out. Like
Same thing
if
with
it has an axle and you can remove it, you're writing the whole dang thing off as personal property.
Same thing, Toby, with car washes. We get car washes a lot. A lot of wealthy people buy. You guys have probably seen car washes pop up everywhere. I don't know about your markets, but they're everywhere.
Yeah.
But when you buy a car wash, what are you buying? You're buying land improvements, which are 15-year assets eligible for bonus, and you're buying equipment, which is also eligible for bonus. So $1 million car wash, you may get a $900,000 write-off in the first year, which is just crazy.
And same thing with mobile home parks. If you're
Yep.
buying the pads, it's all the improvement. You
Right.
guys did one. We gave you a client that was a $1.1 million purchase and $900,000 was the first year deduction.
Yeah.
Is cost segregation under an advanced schedule in an opportunity zone? No idea what that means.
I don't know what an advanced schedule is. We do opportunity zone properties all the time. Cost segregation and opportunity zones work very well hand in hand. I'm not sure what is meant by an advanced schedule.
I don't either. I was hoping you would.
No, I haven't heard that term.
Let's see. What about if I have foreign investors investing in the US? I know that if you're US, you can do a cost seg on any property in the world. But if you're a foreign investor, could you cost seg and get a benefit on your US tax return? I don't think it would affect the foreign return at all.
Yeah, the foreign return, no. The US tax return, absolutely. So you'd be able to take the depreciation on the US tax return.
If I acquired a rental last year, so
23.
yeah, I guess, can I do a cost segregation now for my 2023 taxes?
Oh, that's a great question. I should have brought that up. So yes, the timing on this, you don't have to do the cost segregation study in the year you bought it. So now is our busy time of year because everyone's getting ready to do their taxes. And so we actually have all the way through. Now, if you extend, we really have all the way through October 15th to get these studies done for the 2023 year. And if you don't extend, if you're planning on filing in March or April, we still have time as well to get these studies done. But yes, you can absolutely still do it.
Hey, you know what? I screwed up. Irene wasn't asking about our tax preparers. They're asking, do we have continuing education for tax preparers? And
Yes.
yes, and you would go right to Erik and his team does continuing education for account. How many of you guys are accountants? How many of you guys are tax preparers? Just give me a thumbs up. Give me a reaction or something. How many of you guys are actually tax professionals and you're learning this and you'd like to integrate it into your, oh, look at that. So, yeah, so what you do, still use the link, just reach out and let them know that you are a tax professional. And yeah, Erik's, they do continuing education for us. I'm sure that you would be willing to do it for them too, right?
Yeah, absolutely. Yeah, we're NASBA certified, so we can offer the continuing education, and we'd be happy to set something up.
Yeah, sorry, Irene, I misread your question. I thought you were talking about our people. I was like, yeah, we'll train them. But yeah, you can join the team. We need a, not me, I hate this stuff. Somebody says, forget it. I'm gonna send it your way. Just get it out of my hair. I purchased my condo in 2010, purchased my house in 2014. Can I still use these? I guess is the question.
On the cost segregation side, yes, not on your primary residence. So if your house is where you live, that's your primary residence, you can't do cost segregation on your primary residence. But if your condo, If you moved into your primary residence now and you're now renting out the condo, then absolutely. We would want to run the numbers because it has been, if you bought it in 2010, it's been 14 years. So we just
Yeah.
want to make sure there's still enough that we can bring forward to make it worth it. But yeah, definitely get some numbers run.
What is what if you're house hacking? What if you're renting out half your house or 2/3 of your house?
We have done that in the past. Just keep in mind you want to have that basis over about 200,000. So if you bought your house for 200,000 and you're only renting out a third, we've got to take that 200,000 and divide it by a third. That's probably not going to make sense. But if you bought a, $800,000 house and you're renting out half of it, that would put your basis at around 400,000. Then yes, absolutely, it would make sense.
Yeah, somebody says I just built a duplex for 550. Would it make sense? And
Yes.
yeah.
Yep. Even if you're living in half, that would definitely make sense.
Yep. What is the best time to do a cost seg, before or after a rehab?
Ooh, that's a good question. So before, if the property's in service. So let's say I buy a building, I've got tenants in there, I do the cost seg, then I kick the tenants out, then I do my rehab, and then I do another cost seg potentially. That's the best case scenario. Now you have to have the building in service. So if you buy a vacant building and then you do the rehab, you need to do the cost seg after the rehab's completed. The reason for that is the in service is very important, Toby. So in the first scenario, I said, well, you buy a building and you've got existing tenants. Those tenants are using that flooring, they're using those cabinets, they're using those
In
countertops.
service.
They're in service, therefore we get to take depreciation. When you go replace the flooring, cabinets, and countertops, now you get to take depreciation on the new stuff as well. That's the best case scenario. In the other example, where you buy a vacant building, no one's using that flooring and those cabinets, and so therefore you don't get depreciation. You're gonna have to pull those out, put the new ones in, and now you just get depreciation on the new ones when they go into service. So in service, I think the technical definition is available for its intended use or purpose. Different tax preparers have different ideas on what that means, but that's the IRS's definition of in service. It's got to be available for its intended use or purpose.
I want to ask you a couple off the wall questions then. So I have a client who bought a hotel down in Florida, and they're going to demo it now. Like they've tried to run it 3 years, beat a head against a wall, not liking it. They want to just tear the building down and redo it. Would you retire that entire asset? Would you ever cost seg that thing before, or would you wait till after? And then they're going to
Oh,
rebuild it as condos.
that's a home run. So you cost seg it before they demo it. When they demo it, it all goes to land and there's no recapture tax. And so you
Yeah.
you do the cost seg, get a huge deduction, then they demo it, build the new asset, and then you do a cost seg on the new asset as well. So
And I'd probably sell it. Like I'd sell it to a related S corp or something if they're going to develop it, and then sell those things off as condos.
yeah.
Just yeah. I think they intended to buy something and keep it long, and then it didn't work out. So they're going to do the best they can out of it. Is audit defense included when you do a study?
I can only speak for our company, but yes, it absolutely is. I know there's a lot of companies, a lot of low cost providers where they will charge you extra for audit defense as an extra service. We provide it as our fee. It's built into our fee. And so, yes, we provide 100% audit on our report. Like I said, fortunately, we haven't had too many of those, but we have been involved in some. And usually what they're looking for, it's interesting, Toby, a lot of these agents don't understand cost segregation. In the last audit, I was talking to the agent. They don't even bring in a cost segregation specialist unless the asset is over $10 million. So you've got new agents on this who you're trying to explain to them what you're doing and why you're doing it. We've even had to direct people to the audit guide before, unfortunately. And so typically there's
Here's your audit guide. Please read it.
the audit guide. Here's why we did what we did. Here's the methodology we used according to the audit guide. And so, yes, we provide 100% audit support.
Somebody says we did and by the way, you could do a 45L, a 179D, and a cost seg and bonus depreciation all in the same property.
Yes, absolutely.
Yeah, these are not exclusive. These are not mutually exclusive. Okay. Somehow I keep getting more questions, and I keep thinking we're getting through them, but you might be here till midnight. If we did a full house gutting and remodeling, besides being able to break the new components down into smaller depreciable assets and linking some of the plumbing and electrical as more immediate depreciable items, Does the cost seg also retire the existing assets that were removed, like the kitchen, roof, flooring? In short, are you able to write off the value of the existing assets that you replaced?
The answer is yes, as long as you haven't filed that tax return. So if you did the rehab this year, then yes, and you would have to have pictures because we would have to know what was in there prior to the rehab.
Mhm.
So if that rehab happened 5 years ago, then you wouldn't be able to retire those. In order to take advantage of the partial asset disposition, those items need to be expensed in the current year. You can't go back and recapture those.
So here's a fun one, guys, and Eric, you probably know this, but if you're retiring a roof, go get a replacement value study done, like by the contractor on your entire property. And the reason you're doing that is because you don't know what the roof value was. Nobody does, right? But if you get a replacement value on a house, let's say that you bought it for 300,000 and the replacement value is 500, and you paid $50,000 for your roof, well, that's 10%. So now you know that the value of that roof was $30,000.
Right.
So that when you go and you extinguish it, so you take whatever depreciation you took, hey, I took a few years of depreciation, subtract that off, you're going to get a nice big write-off. There's stuff you can do. Sorry to go down that rabbit hole, but
No, that's exactly right.
we completed the phase one of a rehab on the front house of the residential investment property and converting an oversized garage into a 4-bedroom house. Is it better to do the cost seg after phase two of the construction is complete? So they rehab something and they're about to do a phase two, it sounds like.
Potentially, if it was in service prior to phase one, then yes. If not, we just do everything. If it was your primary residence and you're doing all this work to make it a rental, then no, we would do the cost seg study once it became a rental.
Okay. How do I become a cost segregation specialist in Michigan? Somebody wants to know, I guess, how, like, do you train these people? Do you
That's a
work with
great question.
engineers?
No, so interestingly enough, there is no designation to be a cost seg. There's no IRS qualifying designation to be an IRS, or excuse me, a cost seg professional. So the audit guide does state you need to have tax knowledge, which a lot of tax preparers, CPAs, they've got the tax knowledge. The part that they struggle with is the construction side. So you've got to be able to basically reverse engineer and understand construction. Um, so that's the hard part. There is no governing body. I don't know how you would train somebody on this, actually. It's a great question. So
Engineers. I would say that a lot of times you need structural engineers.
yeah. So that's exactly right. So in our company, we've got CPAs and structural engineers on staff. Obviously the CPAs understand the tax side, the structural engineers understand the construction side, and they bring that knowledge together, and that's how we're able to do these. Very few people have both the CPA tax knowledge and the constructional knowledge, but there is no governing body, so really anybody can do cost segregation.
I am working with Jill Marcon from Cost Seg Authority, so it sounds like somebody in your office. I was told to provide a closing disclosure for my mortgage. Would that be in my signing docs when I finance my loan? I love when they ask questions in these. She also said it would not be necessary for my free assessment.
So yeah, so we prefer to have a closing doc. We don't have to have it. If you know what you paid for the property and the approximate date that it closed, that's enough information. The closing document just has all that information precisely. It knows the actual address. You don't know how many times, Toby, people have said that their building is on 123 Main Street, and I look it up and it's really 123 Main Drive or something, and I'm looking at the wrong building. So the closing statement just gives us precise information of when you closed, how much you paid for it, and the property's address. If you know that information, we don't have to have a closing statement in order for you to get that analysis done.
Can I use cost seg bonus depreciation for long-term rental properties to offset capital gains from cashing out any stocks I own? If so, how would I document that? I can answer that one. I don't think you need to. When you have cost seg, unless you're a real estate professional or you're an active participant in real estate, or we're using the short-term rental deduction, it's going to be considered passive and it won't offset typical capital gains. Now, if you have capital gains from the sale of passive property, like you were in a syndication, then yes, it does offset it because it's considered passive capital gains. But no, typically, if this is just passive loss being created from a cost seg on a piece of on your rental properties, it's not going to offset your stock capital gain. Two different things. I think this might be back to the originals when we're talking 45L and 179D. So just shift your brain a little bit. Would mid-size multifamily, 15 units or so, qualify as commercial? And what about an office building that was converted to multifamily? Would those
So
work 45L and 179?
definitely 100% on the 45L. So any dwelling units, so those would definitely qualify for 45L. In order for them to qualify for the 179D, they would have to be over 3 stories. So it'd have to be 4 stories or greater.
Yeah, 15 units though, it seems like, unless it's like I have a 16 units, 2-story, I guess. Bad. Facts and circumstances. Ask, like, go ahead and reach out to these guys. Your whole team is knowledgeable and they're very fast, and so they could take a look at your situation and see if it applies. Somebody says, what is the cost of a certification? I think that's relating to the 45L and 179D.
Yeah, so the on the 179D, that's based on size and scope. So the bigger the building, obviously there's more work for us. So those range anywhere from about $3,500 up to 15,000 for very large properties. The 45L, those are about $300 per door. So that's just a flat fee. So you just take $300, but you're going to get, like I said, a $5,000 credit. So usually it always makes sense. So
Yeah, that's like a 20-time return.
yeah.
And somebody says those credits are for upgrades, not new construction, correct? Maybe
No,
both,
it's
right?
for new construction as well. The credits absolutely are for new construction. I would say 80% of the 45Ls we certify are for new construction. 20% would be for remodeled projects.
Somebody says, can a commercial equestrian property qualify?
Qualify for cost segregation? Absolutely. 45L, no. 179D, possibly, if there's some type of building structure there at the facility.
And then for 45L, let's say you did an assisted living facility. Does each bedroom suite qualify, or would it only one house?
No, each bedroom, well, if you did, residential assisted living, okay. No, it would just be the one house because there's probably not a place to prepare food in each of those suites. So that's going back to the definition of a dwelling unit, it has to have a place to eat, sleep, prepare food, and use the restroom. And so my guess is those suites probably don't have their own kitchenettes.
Somebody says, if we live in a house for 5 years and then move out and they did the new windows, new HVAC, can you do the 179?
If you moved out and made it a rental property, yes, again, it would probably need more than just new windows. You would probably have to rip the sheetrock off, replace the insulation, the windows, the heating and air, the lighting, but yes, it could qualify.
Are the credits or deductions for and I'm going to say 179D and 45L, are they subject to recapture if you sell the property?
No.
But cost seg potential recapture depending on the
Yes.
value. And a
Yep.
bunch of people were asking about that. Like, is it up to you as to whether you put a value on the carpet that you sell on you?
Well, there is a form, and you're better at tax forms, so I think it's 4797 where you allocate the sales price upon sell. And that's the form that you're going to say, hey, the sales price, I bought it for $1 million, I sold it for 2 million, but that gain was not because I'm selling my carpet for double. It's because the land and the walls went up in value. And so that's how you're able to manage and shift things from getting recaptured at ordinary income rates to just being treated as capital gains.
Somebody's trying to call that phone number that you have listed there, and they said it's busy. They've called 3 times.
It might be busy. Sorry. We do get an influx when we do these with you guys, Toby. So typically we respond to all the inquiries within 24 hours. I'll be honest with you, it's probably going to take us 2 or 3 days to get to all of these, but just keep trying to call that number. Let me see. I'm going to give another number here in case anybody's having any problems. It's just our 800 number. It's 1-800-940-3115. So the number that's there on the screen, that comes directly into our team. But our 800 number will come to the whole building. So if you're having a hard time getting in, it's 800-940-3115.
And I'm just gonna put that link up, just use the link. There we go. Oh, and then Jennifer just shared the second number. Yeah, we're probably breaking it. Sorry, guys, there's a lot of you on here, and I'm sure a lot of people are calling. The best thing you could do, honestly, is because I like to know how many people and who comes from us so that we can make sure that we know that you're doing these things, especially if you're a tax client. We want to know that you're working with Cost Seg Authority, because the last thing we want is to go through a tax season and you think that we know, I'm doing a cost seg study, right? We're like, how am I supposed to know? You didn't tell me, right? Like we need to know so we can get a list from Erik and his team. Can I use cost seg on a floating condo, a houseboat, used as a short-term rental? It's interesting.
Question I haven't got before. I don't know the depreciable life on a houseboat. I'd
It's
have
like an
to.
RV. It's actually like an RV. As long as it has a sleeping quarter, head, and a kitchen, I think you could actually write it off.
Yeah, that's what I'm thinking.
Yeah, it's kind of weird. It can be a second home. I actually lived on one for 2 years.
On a houseboat?
Yeah, I thought I was a pirate for a little bit. Went through a pirate phase. No, it was in Seattle. I lived on Lake Union. If you ever seen Sleepless in Seattle and all
Oh, yeah.
those.
Okay.
Yeah, it says you can't write off land on a houseboat. You can never write off land, Armin. You can never write off land. I always have to say that. So it doesn't. I don't laugh because you're on water. You do have condos. Like you could buy a condo that's on the water. It's kind of weird. I guess maybe you own a little piece underneath it or something, but you can buy a spot. When do you recommend conducting the cost seg, before or after improvements? Okay, you already answered this once before, but it depends on whether somebody's in there.
Yep. Back to your facts. Facts. Depends on if somebody's in there. We'll always consult to do it before if possible. But it's not always possible depending on whether it was in service or not.
All right, guys, we have 5 more questions. That's it. Please don't ask any more questions because then I'll delete it. I'm just kidding. Have you ever conducted a cost seg in Puerto Rico?
Yes.
Here's somebody who you did a cost seg for. It's Juan. He says, hey, you did a study for me. We calculated in 2023 at 80%. Will your firm redo the cost seg at no cost to reflect the 100% change, or will there be a charge for us? Actually, it wouldn't matter to you guys, right? We just would apply the 100% bonus depreciation.
Yeah. So we typically won't. We can redo the study, but the bonus depreciation actually gets applied from your tax preparer. So there's a button that you guys click, Toby, in your tax software that says whether or not it's eligible. And that's where the bonus gets applied. It doesn't need to state it in the report. They're taking our numbers. They need to know how much 5-year assets there were in your building. And that's the numbers they're pulling from ours. But then it's actually on their end whether they're applying bonus or not on the end of the report.
Yeah. I've heard that bonus depreciation is sometimes not available when the transaction was between related parties, family members, or related business entities. Can you expand on this?
Yeah. So typically, if you inherit a property, it may not be eligible for bonus. Goes back to intent. You have to have bought the property. So if your father bought a property in 2010, your father unfortunately passes away and you inherit the property, you cannot apply bonus depreciation to that stepped up basis.
What if it was an investment property? So same situation, but it wasn't their primary residence, but it was an investment property.
You still can't apply bonus on step up.
So for an inherited property, you get to depreciate it again, but you don't get to do the accelerated, because
The IRS wants, again, they use bonus to stimulate people to go out and buy stuff, and you didn't buy that property because of bonus. You just happened to inherit it. Therefore, they're not going to give you the benefits of the bonus.
Chris says, you mentioned needing a cost seg study. Can I do that myself, or do I need a certificate? I think you went over that a whole bunch of times.
Yeah, no, you definitely shouldn't be doing cost seg yourself. You don't have to have a cost seg study done. I have seen some tax preparers. What did he call it? A guy called me who I've worked with before. Oh, he called it a casual cost seg study. So he had inherited a client And this prior CPA had done a casual cost seg study. So I'm
Cash
like,
flow.
John, what the hell's a casual cost seg study? He's like, well, let me send you the depreciation schedule. I think you know what I mean. So I get the schedule and it says building $1 million. Underneath that, there was 3 line items, all perfectly whole numbers. Parking lot, 80,000, appliances, 15,000. And all the CPA had done was break out those 3 components so that they could take advantage of some bonus depreciation. Well, a couple things. One is they grossly understated those amounts. The parking lot, when we actually did the study, was way more than 80,000. So they missed out on that opportunity. And secondly, if it ever gets audited, the agent is going to say, okay, well, is that 6-inch asphalt or 4-inch asphalt? And you better have some definition on, or some definition around why you came up with that number and how you calculated whether that was 4-inch or 6-inch asphalt. So the technical answer is yes, you can do it yourself. Don't ever do these yourself, though. You're leaving money on the table and you're never going to be able to support it in an audit.
You're just going to ask for trouble.
Yeah.
At the end of the day, I always say this: you can go to somebody, like I always say, like when they go to a chain preparer, they did a study once with the inspector general. 100% of business returns were done incorrectly when they ghosted and did a sampling of the chain preparers. And so we always say like this: hey, great, you might save yourself $500, but it costs you 5,000.
Right.
Don't do that.
Yeah.
Just, yeah, there's a value to these things, and you use the gold standard. You don't do the whatever somebody decides they're going to do, some hey, I'm just going to guess.
Right.
Don't do that, because you could open yourself up to penalties galore, and frankly they should be, I don't even know like what methodology. At least get somebody to come out there and do an estimate on the dang thing. It's
Absolutely.
crazy. So there's that. And then you don't need their tax return to do the analysis, do you?
No, typically not. It is
All right.
helpful if it's easily available, but typically not.
And if you bought properties previously, yes, you could do the catch up. And the year that you put it into service is the year as to whether you get the bonus at 100. So 2018, 2019, 2020, 2021, 2022, you put a property into service in any of those years, reach out and see whether you get a nice big tax savings in any particular year. You do not lose that loss. Like, so let's say that you had a passive loss and you're like, oh, I wiped out all my rental income, but I can't use it against anything else. It carries forward until you dispose of a property, then it gets released and it offsets that gain off that property and can even offset ordinary income beyond that. Or you're offsetting future passive income. So you're not going to be paying any tax on your rents for any time. So like these things are really beneficial, guys. And it gives us another tool in our toolbox to play with when we're trying to minimize your tax burden and get you to keep the most of your money. So please use Erik and his team. We've been working together for years with great success. We don't plan on doing anything differently now. So use the link that we've sent out to you. Keep it in your back pocket. If you want to, if you want to use the fact that you're with Anderson as for somebody else's benefit, share that link with somebody that you think could benefit. We're a community, so if you have friends, they're our friends. But just go in with your eyes open and always, don't try to cut corners on these things. Work with people that this is their niche, and please go in with your eyes open, know what that benefit's looking at, and these things can be huge. And sometimes people are shocked when you put it could be a large amount of money that comes back in your pocket, and people feel weird about it, like, oh, this is going to get audited or something. Very seldom. Very seldom, and we've never lost an audit when it comes to a cost seg, ever in our history. And I think the same is with you with over 20,000 studies, right?
Yeah. Yeah. No, we've never had to change our numbers. Like I said, they're just looking to make sure it's done correctly. And so as long as you're following that audit guide, you should be fine.
All right, guys, we'll put this up on YouTube. We will send you guys the replay. Share it with anybody you think could benefit. If you're an accountant, please reach out to Erik and his team. They'll get you professional credits on this. You could probably ask as well to get the study credit on it, because it's already been approved in other jurisdictions.
Yeah.
Even on this one, you could just share it with them. But and then go forth and spread the word that there's always other ways that you can get benefits out of the investments you guys are doing, and we need more housing. We need housing really bad in this country. So use every incentive you can so that you can get as much property out there and in use for people for housing, because God knows we need millions of units. And so it helps the little groups like us to go out there and get more. Thank you, Erik, for spending the time with us, my friend.
No problem. Thank you guys for having us. And I'll just end with what Toby said. Thank you guys. Please use this as a resource. We don't bill by the hour. We want to make sure we answer any questions you guys have. Toby, you guys have been great. Thank you again for the opportunity. You guys are always a wealth of knowledge on your end.
All right, guys, give them a reaction, give them a thumbs up, give them a heart, and just say thanks. Really appreciate you taking the time, Erik, and go out and have a great day. And everybody else out there, go out and have a great day too. Thanks for joining us, and we will see you next time.
Thanks.